Good morning. This is Brad Olson with Oaktree Financial Services. I want to start our webinar. Every quarter, we do an economic update at Oaktree just to cover a little bit about what's going on in the markets, how it affects your investments, and an overall look at what's going on in the economy. We think it's very important that we communicate kind of where we're at and try to put some context to why we're looking at investing in certain ways at certain times. So that's really going to be the goal of the meeting today, is to make sure we kind of get some base to kind of set our future strategies. And feel free, if you do have any questions, there is a Q&A on the Zoom meeting. Feel free to submit your questions. We'll answer those at the end. We love to get questions and go through those. So feel free to let us know what thoughts are on your mind. Our agenda for today, when we look at going forward, is going to be mainly covering what happened a little bit in retrospect. Now talk a little bit about what's going on with the bear markets, some surveys that we're looking at, and talking about what can we do to make sure we're well positioned going forward. And again, feel free to let us know what questions you have. Just want to let you know, as we go forward, we are recording this and we do post it to our website. So just to let you know that you will be part of that recording. We do have to let you know that from a legal standpoint. So if you have any questions on that, feel free to let us know. Oaktree Financial Services was founded in 2009. We're a firm that we have 6 of us in the firm. We're very excited to service a lot of clients and meet their needs as far as their financial goals. We're located in Brookfield. It's a picture of our building. If you haven't been here, we'd love to see you. I know most clients have been in. If you're not a client of ours, feel free to stop in and say hi. Now, as we go through this, we're going to cover some of the recap of what's going on in the what happened in the first quarter. Then we'll take a look at what's going on now, and then the second quarter, and what's going on for the rest of the year. So first of all, there are some various disclosures and information that we have to make sure that we cover. I'm not going to go through this in detail. As you can see, it's quite long. It talks a little bit about where we get our numbers. I do a lot of research on various different government sites and things of that nature to put together these figures. So we do have to sort our or show you our sources as we go forward. So that's what all of these are. If you want to see these in detail, we can show them to you. Now, a little recap of what's going on for the second quarter and where we're at on a year-to-date basis, just to give you an idea. It has been a tough period of time when you look at what's happened with the S&P. Matter of fact, the S&P 500, it was the second worst quarter we've had in quite a while. Matter of fact, if you go back to 1970, we had a 21% second quarter downturn. You can see when we look at the second quarter here, you can see what the Dow Jones was, what the S&P was, and overall what the NASDAQ was, which are more technology related stocks. You can see on a year-to-date basis, the Dow Jones is down 15.31, the NASDAQ pushing the 30 mark, and the S&P around 20. Now, the good news, and this is why we have to always put things in context from an investment standpoint, over the last 3 years, we do have positive returns since 6/30 of 19. So overall, we have seen for a longer term investor that even though we've had a pullback, we still are seeing some very positive numbers when you look at the returns that we averaged over those years from that time frame, or what we've seen these indexes go up. Now, I also highlight on here, and I'm just going to annotate a little bit to show you, when you look at the 10-year treasury, and the reason I highlight the 10-year treasury, it's kind of a benchmark for what we're looking at as far as how kind of fixed income rates are set. You're looking at a lot of the mortgage markets are kind of based off of the 10-year to a degree. The Fed looks at the 10-year quite a bit. You can see in June 30th of 2022, we were at 2.89%. As of 6/30 of 21 last year, you can see we were at 1.44%. So overall, we have seen a fairly doubling of the 10-year rate. Now, again, in relative terms, that's not a bad number when you look at that, where that 10-year rate is. Now, for savers, we do many times, they like it when the rates go up. If you're in more of a fixed income market where you're seeing that you're in a CD or something like that, you'll see those rates increase. Have not increased dramatically yet, though, and actually we've seen a little bit of a pullback on this recently, because actually this went up to about 3.2 at one time. It's pulled back as of June 30th to 2.89. This varies per day, so it's not a locked in number. Now, over 3 years, you can see basically, if we look back 3 years ago, the 10-year rate was at 2.02. So we did go down in 21 as we made money very easy to get as we went through the pandemic. And now we have seen a slight increase over that period of time. Just remember, the reason we talk about those rates is a lot of various lending rates are pegged off of things of this nature, that and the Fed fund rate and prime, which is usually the Fed funds rate plus 3% approximately. So it gives you an idea of kind of when we're talking about these numbers. So a little bit of looking back at that, I did want to highlight, if you look at what's going on with the markets, you can see, for example, you go back to 96 right here, you can see we have had a lot of ebbs and flows over this period of time. Overall, when you're looking at this, you can see that we have had, now the good news is, if you look at it like this, we have seen a fairly nice increase in the markets over the years. That has not been without some situations where we've had drawbacks. We had the situation, the early 2000s was the whole tech bubble. We got into the whole housing market, the whole collateralized debt problem that we had. Then we had the pandemic. And now we're basically pulling back due to the business cycle and inflation. I did one of these about a month ago in June, just as kind of an impromptu. One of the things I talked a lot about there was the business cycle and what we're seeing here. For example, when you looked at what happened with the pandemic, that was really event driven. That was something that was not caused as much by the business cycle, but by the pandemic. You look at back here, this was one that was more of a structural situation, where structurally we had an asset class being the whole debt housing market, where basically that caused a big situation. This definitely is more classic business cycle. When we get into this, you're going to see that you're going to find that overall, this is really much more of a business cycle correlated downturn. And that's why I'm going to talk a lot about the business cycle as we go forward. Now, there is an event-driven part of this when you're looking at this, which is kind of the Ukraine event. That is event-driven because that's a war type of situation. So as we're going through this, but this gives you an idea that the market is not a straight line. And I always tell people, when you're investing in equities and you're investing in market correlated investments, even on the bond side, they are going to fluctuate. And it's just something you have to be prepared. Now, the key is, and we'll talk about this, and I talked a lot about this in my June meeting that I did, is staying the course to a degree. And we'll talk about your options you have as an investor when you're going through this. One is you can get all out and try to time when to get back in. Very tough game to win. The other is you get out and you don't want to participate in this anymore, and you want to go into more things that are going to be much more predictable. Now, the situation is, if you do that, you are going to miss out on some of these higher returns. We really like the strategy of staying the course to a large degree, but then adjusting according to what opportunities we have. I always call it market logic, not market timing. Market timing is a very tough game to win. Now, the next slide really goes into talking a little bit, and I want to highlight kind of what we've seen with bull and bear markets over the years. Now, what you'll find is when you're looking at this, so if you look at right now, what we've seen is what this is showing here is basically some of the bull markets, how long it took for us to go from peak to trough, how long then it is going to take us to come back, how long is that going to go. So in January of 2022, we officially went into a bear market. By a bear market, we've seen a decrease of 20%. So we've seen a fairly large decrease during that period of time. So the duration so far has been about 5 months. When you look back at bear markets that we've had over a period of time, what you're finding is that they vary in the length of time they take to come back. You can see here, we look at 2000, again with the tech bubble. We look at the situation here. Now, the good news, when we look at the pandemic correlated one, that was very quick. So if you look back, how long are we going to be in this bear market? No one knows this. So the question is how long? Now, this is what we're saying is, how long does it take us to recover to get back to where we were? Now, one of the earlier slides I put up showed about, for example, over 3 years, we still had a pretty solid returns. So when you're looking at this, it doesn't mean necessarily that you've given up some of your gain, no question about it. And that does always concern us because we had a certain dollar amount. I know people that I've been clients of mine have heard me tell the story several times. As I use the example, my parents used to go to the casino once in a while and do the slot machines. I asked them, how did they do? They said, well, we started out with $20, we went to $40, and we left with $30. When I asked them how they did, they told me they lost. Well, in my math, they went from 20 to 30, so they actually won. But the key is, as an investor in just human nature and emotion, we remember that we were up to 40. Even though they went from 20 to 30, they still were up $10 in a relatively short period of time, but they didn't walk out with 40. That's what's happened with this market. We've seen that our $40 is down to $30. So again, emotionally, we never play off. That's not something we should just say, don't worry about it, because it is a dollar amount that you were up to, especially as we're looking at as we get into retirement, which many of our clients are, that we want to keep as much as we can. But the problem is, and we go through this, is that if you try to time and get out and get back in, because so many of the cluster of returns on the way back when the market's coming back happen very quickly. And if you miss those days, you miss out on a big part of the market. What this is just showing us is to get back to where we were, to the peak of the market, which was a pretty nice number. This just says in 1 year, you'd have to go up 28%. Over 2 years, you'd have to go up 14% a year. Over 3 years, you'd have to go up this. This gives us an idea of how long it takes to get back to the peak. Now, again, overall, I'm on Dad's example, they still were up. It's just, are you going to get back to where you were? So just kind of a side note on that. Now we're looking at S&P valuations. I just want to highlight quickly here. One of the things that's a base of our industry for a long time is price to earnings ratios. Very simple, probably the most simple gauge that we look at in buying stocks. It just tells for every dollar of earnings a company has, what is the price of that stock. So if you have a PE ratio of 30 to 1, it just means that overall you're looking at, for every dollar of earnings, that stock is 30 times that. Now, if you look at a 25-year average of the P&E ratios in the S&P 500, it's 16.85. Now, we have had much higher peaks. We go back to this standpoint, we were in the neighborhood of around 28. We've seen different peaks that we've had. Now, the good news is, and bad news, is we have pulled back on our PE ratios, which just means that overall stocks are probably more average priced than what they were for a period of time. Now, again, all these ratios, you have to put caution in how you state these things. But the bottom line is, over time, if companies make money, their stocks do well. If companies don't make money, their stocks will not do well. Now, you are willing to invest in companies that will not have much of a PE ratio because they're growth companies. If you look at various companies, you look at a Tesla or whatever you're looking at, in the beginning, they have no PE ratio because they're investing all their money back into the company. There's really not much earnings or no earnings or actually negative earnings where it's being funded through loans or, through the stock issues that they put out and brought in money to the company. Now, eventually, though, if a company doesn't show earnings, then they won't be a solid company. And we talk about investing later on. One of the things that we're looking at are what are some good price to earnings ratios. I've really seen a lot of companies pull back dramatically on their PEs, and I'm looking at, I think we're getting closer to being some opportunities out there in those companies. So just a little basis of why we talk quite a bit about PE ratios as we go forward. I want to talk a lot about the business cycle. This one's going to focus on that quite a bit. All the numbers I'm going to talk about in the next few slides, which I'm not going to spend a ton of time on those, but I do want you to understand why we talk about some of the underlying economic indicators. So all these numbers you hear in the press, you listen to CNBC or Fox Business or Bloomberg or whatever you're listening to, they're going to talk about various indicators. Why are they important? The bottom line is it tells us where we're at in the business cycle. It's that simple. What you're trying to do. Now, the problem you have is interpreting those numbers. I was talking with a client the other day and they're saying, well, why isn't the Fed better at predicting where things are going to go? Well, that to me was a direct statement of how tough this is. I mean, the Fed is sitting on endless amounts of data. That's where I get most of my data from. What happens is they can't interpret it because I always tell people the market is a living organism. And sometimes that organism is not going to react directly the way you think it's going to go. I do know overall that this business cycle is going to happen. Now, the question is how long do we stay in these various phases? Because it does not click like a clock. It will stop and go. So when we're looking at this, this is very important. And that's why you're going to find when we're managing money, we talk a lot about the business cycle. So what are some of the numbers that's giving us indications? Again, there's an endless amount. I pulled out a few that we're going to cover. First of all, we're going to start with the big one, which is inflation. Right now, inflation continues to run very large. Currently, we're seeing a 9.1% overall inflation number when you're looking at that. So if you look at CPI right now, we're looking, and this was a chart that was actually before the number we just got the other day. When you're looking at this, what you'll find is we've seen the highest increase in prices. Now, why is inflation such an important element in the business cycle? Because it is the number one thing that as an economy you try to control. You want to look at how much are we producing and basically how much our rates or how much are our costs increasing to the consumer, because inflation is one of the things that can dramatically change how an economy works. Because the bottom line, if all of a sudden we're paying so much for goods and services more, it affects everyone. And the problem you have is, and this is just a personal comment, it really affects the people on lower income. So it is one of the more regressive or proactive, I guess I should say, taxes that you'll see on someone. All of a sudden, if gas goes from $2 to $4, you've just dramatically changed some people's lives that are working construction and driving 50 miles to the job. I mean, it does make a big difference. So when we look at this, now, what are the reasons for inflation? The pandemic. We put a lot of money in the system to help people through the pandemic. We put a lot of money out there, a lot of debate, and I'll leave my political comments on the side. We probably shouldn't have, and again, both sides were part of this. We probably should not have put as much money out in the system we did, especially the last infusion that we did. Now, one of the areas that there's a lot of discussion about is there still wants to be a Build Back Better dollar amount. I know there's going to be a lot of debate on that. And I think you're going to see that that's going to be a tough one to get through, because that would really be putting fuel on the fire if you threw out more stimulus into this economy right now. So that's one of the things that's done this. I always go back to college. I won't say the year I got out and started dating myself here, but one of the things you'll find is we always talked about money supply in econ classes, because at that time, money supply was one of the keys that you looked at of how inflation was going to react. The more money you have chasing goods and services, the higher prices will go. So what happens is, with the more money you have out in the system, it drives up prices. That's what we saw happen. We saw our money supply increase dramatically. And then what that did is it caused a competition. Then we saw with the pandemic that we saw productions of goods and services come down. So you had a lot of money chasing limited goods, which fueled this inflation. So this shouldn't be a surprise. I mean, this should not be one. And this is where I think history will tell us that the Fed was probably a little bit off in their predictions, saying this was transitory. It was really, when you looked at it, and that's one of the areas that I felt, and I think we felt here as a firm, that transitory was a term that was being used very incorrectly in saying that this was going to go away very quickly. Now, there is a lot of debate on where it can go. The bottom line is we do have some numbers that are still fairly positive with employment and some of those things. But until we address this and get this money supply down, and that's why the Fed is doing the things they're doing with taking money out of the system and raising interest rates, which basically takes money out of the system. So it is very important we look at this. Now, one of the keys when you're looking at these numbers, especially the ones that recently came out, basically, I mean, there's two parts to this when you're looking at inflation. There's core inflation, which takes out food and energy. That's at about 5.9%. You put back in food and energy, we're at about 9.1. June was a very tough month for the increase in energy. There's always debate on this. I personally am always a little skeptical when you take those numbers out, because they are a big part of what's costing people money when you go to the grocery store or you stop at the gas station, which we all have to do quite a bit. Now, but the reason you look at it that way, it can be very up and down. Now, for example, if you look at, we've had a bit of a pullback in the price of oil and the price of gasoline, which correlates. when you see that, of course, the politician at once, Biden in this example, is saying, these numbers are baloney. The 9.1 is not true. Don't take that into account. We're doing much better. Could be true. I mean, we did see prices come down, so it could, but that can change very dramatically too. It just takes some various conditions, i.e. that supply is not there. There's a change in the Middle East, whatever it may be, a change with the whole Ukraine situation, which put a big strain on this. We get into winter, that's going to change the formula also due to the fact there's going to be much more of a bigger demand for heating. So those are going to change it. So that's one of the reasons why there's a big debate on where this number actually is. But the other ones that are really affecting us when I look at this, you start looking at like transportation and all those things, everything's being reflected and it works its way through. That's why the energy part, the gas part, the diesel part is such a big part when we're looking at inflation. So that's the first thing I wanted to cover. Just quickly, this shows what makes up inflation. So when you look at some of these numbers, you can see, for example, energy is the big number. Now, this doesn't even include June. This chart does not. If you throw that in, actually, that becomes even a bigger number. When I look at energy, that actually went up to 10.4. So this number went from 8.6, looking at my notes here, up to about 10.4. So we saw a dramatic increase in that energy category during that period of time. So when you're looking at this, that was one of the reasons why we saw the 9.1 number. But you can see all of these things. This has been a pretty steady increase that we've had. Now, again, I'll let you debate in your own mind of what caused this. There's a lot of different causes. And I will say Ukraine was one. I mean, that whole situation. And again, especially a lot of the food prices, that is the reason. And then I think some of it was self-imposed. And again, you debate the issue on the whole green issue. That will depend on what your view is. I agree with it. I think we need to address a lot of it. I'm just not sure we need to address it overnight because that is going to put pressure on some of these categories. So enough on inflation, but it is an important part that we do look at. Another one I looked at was construction spending after inflation. This is actually a negative sign. And just to let you know, I do about every 2 weeks publish on our website kind of some of these updated numbers, and I highlight them yellow, green, and red to kind of give you an idea of what the thoughts are as far as where they're at. Are they positive, negative, or kind of neutral when you're looking at this, or kind of saying slow down a little bit? This is one that is a big one. I mean, construction spending has come down dramatically over this period of time. That will reflect in employment eventually. Construction business plays a big part of our economy as we look forward. Another one I'll cover, and I'm going to go through these fairly quickly, is when we look at durable goods orders, which are bigger purchase items. We've seen that slow down dramatically. Again, now during the pandemic, they slowed down completely. Then we did see a massive increase, which was fairly solid. And now we have seen that has slowing down. And again, one of the areas that I'm going to talk about in just a second is inventories, which is very important when I look at this. When you see this, what we've seen is we've actually seen now, when you look at some of the inventory numbers, we've started to see those increase. So we've seen consumption go down. We've seen inventories go up. Very simplistically, what that's going to mean is eventually this is going to work its way into employment numbers. And that question is, how quickly will it? Because right now, the strength of what we have, and why a lot of economists are predicting this recession or officially a recession here eventually, is going to be relatively short due to the fact that we have such good labor numbers. Again, how much are those going to deteriorate before we see what the Fed is doing slow the economy down? Because remember, the number one thing the Fed is doing with raising interest rates is to slow the economy down. That's the goal. I mean, if you kind of didn't realize that from the beginning, that's good. Because if we didn't do that, if we kept throwing money at this thing, inflation would continue to grow and it would be much more of a deeper fall in the future. I did want to highlight a little bit what's going on with some of the commodities. We have seen a weakening, for example, in copper, which to me is always a very good indicator of kind of where the economy is going. We've seen lumber slow down dramatically, a little blip, but overall it's down from its peak, which again goes to that whole construction standpoint. So when we're looking at this, you can see that we've seen some of the things that are starting to slow down overall, which does usually indicate weakening business conditions. Gold prices, I know there's always the William Defoe crowd that loves to invest in gold. We have seen gold pause. It's kind of interesting because one of the areas that gold usually is silver, copper, they're used in industry. Gold is really, besides jewelry, is not a big industry thing. It's not like you're putting gold on the tip of a blade and cutting things. It's one where you look at this, we have seen that gold has actually pulled back. This actually is probably looking a little bit at not a bad thing, actually. Because it could mean that clients aren't just heading, or people aren't just heading to gold as the number one thing, as a hedge protection. 30-year treasury bond yields, we have seen those start to pull back a little bit. If you look at the longer term treasuries, and actually, we've seen since the beginning, over the last couple of months, that actually some of the bond holdings have done better due to the fact we have seen a little bit of a pullback in interest rates. The dollar is strong, which just means that we are still a bastion for the world. They do like investing in dollar. Matter of fact, look at the dollar to the euro now, and it's quite interesting. So what you're seeing is that overall, the dollar is a fairly strong number. Now, when it is like this, that it usually means that business is probably going to start declining a little bit when we see it at this number. Consumer confidence, I did want to spend a second on that. When you look at consumer confidence, I mean, again, depending on who you listen to, and this is just a more of an editorial comment, this is probably, in my 40 years doing this, is probably the most that I've seen economists vary on thought process. There's some people that I listen to and watch and have followed over the years that are very positive on where things are going to be heading here relatively shortly. There's others that aren't. There's really a variation. Now, the only thing that I hope I've seen probably penetrate a little bit into people's thought process is a little bit what's going on with their political views. It used to be that economists were pretty insulated from that. I am finding, depending if you kind of look into whichever party that people like, they'll either be super negative or they'll be super positive. I look for economists that are just looking at the numbers, because that's what we're looking at, is what are the numbers. But consumer confidence is very important. When you go look back here, we're back to a consumer confidence level of kind of when I got in this business in the early 80s. So this is something we're going to want to start to see turn around here in the near future, because it does make a difference as we go forward. When you're looking at this, these are very important factors. So when we're looking at overall numbers, let me just flip to the next slide. I want to talk a little bit about the business cycle, and a lot of this I'm going to go to fairly quickly, but I do think it's important that you understand. When we're looking at the business cycle, we look at the different phases. We have phase 1, phase 2, phase 3, phase 4. Now, the reason I've always talked about these phases is it's very important when we're looking at the business cycle to understand what's going on. And I'll tell you where we're at in just a second, but in each one of these phases, and actually if we put a different one of these, I actually divide this into 8 different categories during these phases. Basically, when you're looking at it, we start here with 1, 2, 3, 3 goes back over here, then we go 4, 5, 6, 7, 8, and we come back to the bottom. Now, when we're looking at that, as we're going through this business cycle, this is natural. This is good. Now, the key is you want to have these ups and downs be somewhat normalized. You don't want them to be huge, but having a business cycle is an important part of our economy. Because if we did not, and we just let things expand, granted, we may go way up back here again, or kind of going back to this side, but if this keeps going, the crashes are always so much bigger. So when you're looking at this overall, I mean, what you have to do is you have to say, this is logical. This is not a bad thing that we have. What I wanted to highlight here just briefly is in every part of this business cycle, there is a place that we're looking for investing. So when we're looking at, for example, in these early phases here, when we're starting here, we're not there right now. When we go forward, you're going to see that we are not, and I'll kind of tip my hat here, we're about right here, right now. This is where we're at right now. So we have a ways to go on the phase 4, but then we'll come out and we'll start expanding again. We'll keep expanding. And what happens is when you're looking at that, what you'll find is that the growth of money supply changes. We'll find that just various ratios that we're talking about, they will change. So the growth, what you find is I put in here, investors like right here, business recognizing the economy is in an upward trend. Optimism creates demand for capital. The dollar rises, reflecting improved optimism. The Fed lowers rates and increases the money supply. That's what's happening during here. You'll start to see that what they'll do is they'll start actually lowering rates eventually back in here again. That starts this cycle again. So as we're going through these, one of the keys is you always have to realize as we're going forward that in each phase, there's different things that we're looking at of how we're going to invest. And it's so what we want to do is we always want to understand where we're at in the business cycle. Now, this is not as easy as this academic exercise that I'm showing here. To predict where you're at, again, a lot of people with a lot of big time computers and a lot of staff, the whole federal government has a whole area that's doing this through the Fed. What happens is it is a very tough thing to judge. So as we're going through that, what we're looking at, these are some of the points that we have. Now, right now, when we're looking at where we're at in this economy, I just want to jump to that a little bit. As I said, we're about right here right now. We're just getting into this phase. We've been in the process of raising rates. We've been in the process of pulling back with money. Now, what's going to happen is that does slow down the economy. The key is, though, you start investing here in a much more aggressive way in certain things, even though the economy seems like it's not great yet. Because what happens is the stock market will start doing better than how the business cycle seems, because you're not buying a stock for where it's at today, you're buying a stock for where it's going to be. So this is the challenge. And if you're missing these because you still don't feel totally positive that the world's great, you miss a lot of the returns. And this could happen at any time as we're going through this. All of a sudden, we could accelerate very quickly down to here. And this is where I tell you, market timing is a very tough thing to do. So as we're going forward, we have to be looking at where the business cycle is. Now, when I'm talking to people about investing, one of the areas that we look at is really talking about kind of a process. First of all, the methodology is looking at, one is, what is your timeline and your goals? I mean, that's the number one thing that we're looking at is what are you trying to do? Where are you at in your life cycle? Because depending on where you're at in your life cycle, we know, for example, back to the chart that I showed originally that talked about how long bear markets last, how long cycles go. I have all that information. There's averages, and averages are just averages. Some are a lot shorter, some are longer. But what happens is, if I need all my money in a certain period of time, I have to be cautious of how I invest. If I'm going to be taking out income, depending on how much income you're going to be taking out your portfolio, we have to understand what that is to make sure we always have money we can get and don't have to sell something we don't want to sell. So that is very important. So these two right here are really focusing on you. What is your goal? What is your timeline? And then what is your risk tolerance? You know, I have example of people, I grew up in the banking world in my first years in kind of the finance side of that part. What happened is you saw that for some people, whether they bought a 6-month or a 1-year CD was different risk. I don't want to take the risk. That really wasn't much of a risk. Now, when you get into equities, yes, every equity has an inherent risk to it. You have two risks. You have one, the business cycle, how it's going to be affected by what's going on with the economy, that whole thing. But then you also have the company. I always tell people there's two parts to stocks when you're investing as far as risk. One is just overall what's going to happen with that sector, with the economy, what's going on with that business. But then you also actually have the individual company. If you have anything that they've done that's out of the ordinary, I mean, if you're investing in a chemical company and they basically wipe out half of the population, that stock's not going to do very well. So you have things where it's particular to that situation. Enron, for example, you had a lot of malfeasance within the company that affected that stock. The industry wasn't affected the same way. It was to a degree change, but not the way that that stock was. Now, the other part we look at is asset allocation. Now, in our business, what you see is a lot of people look at asset allocation only. And I believe in asset allocation 1,000%. You look at not having all your eggs in one basket. And I'll talk about that. But we also believe in saying with the business cycle, what we should do is adjust this asset allocation to a degree to take advantage of what's going on. So if I was a 60-40 investor, 60% stocks, 40% bonds, cash, things that are going to be a little bit more of a less of a volatility, hopefully, what happens is if I love the market, maybe I go 70-30 for a while. If I don't love the market, maybe I go down to 50%, 40%. Now, I don't ever suggest that a person gets all in or out when you're doing this, due to the fact that if you do that, again, back to that timing, if you got out when it seemed bad, you may never recover those losses. It's very important that you're in the market. So this helps set your personal investment structure. Now, one of the areas that I've been spending a lot of time with people on is talking about the bucket theory. And what I mean by that is basically looking at your money that you have and determining we have liquid investments, which I basically say are emergency type of money, major planned expenses in the next 3 years, and up to 1 year's income set aside. So if I needed $50,000 for emergency money, if I needed 30,000 here, if I needed 30,000 here, I may be sitting with 100,000 or so just in more cash related investments. Especially as you age, this becomes more and more important. But one of the keys is, if you're not a client of ours and you're on the webinar, I know we have some people that are here that aren't, you should know this. This is something your advisor, and I've been trying to honestly tidy up the questions on this with our clients, saying, how much do we need here? Semi-liquid investments. How long, again, before I need the money? Now, I always say to people, I do try to set aside, for the next 5 years, if we need income, I'm not going to keep that all in cash, but I'm going to earmark that. So if I go into a business cycle that's going to last on the downside for a while, and it's going to hurt stocks, I want to be able to get at that income that you need to take out. Very important. Then we really get into the longer term investing, which we can let business cycles run through their course, and it's not going to change dramatically our investment style. So this is very important. And again, if you want to talk more about this, feel free to let me know, because this is one of the areas I'm trying to get on file with every client or every person I talk to when we're talking about investing. Very important. Now, back to asset allocation, just a quick note on this slide. The white is basically an allocation of about a 60-40 allocation over the years. Now, if you look at, and I'll use small cap as an example. So if you pick out kind of this orangish color right here, you can see small caps have some years where they really do well. Look in 2020, great asset class, top asset class. Now, blatantly honest, if we were psychic and, we're really, really great at our job, and I don't know how you do this, but it'd be fantastic if you could, you would just buy all these asset classes every year if you knew which ones were going to do the best. And the business cycle will give you an indication, but the problem is it's not always accurate and it's not clicking like a clock. So if you do asset allocation over a period of time, it lowers your risk dramatically by doing that. Now, if you look at from 2007 to 2021, your annual return on asset allocation was about 6.1%. Now, granted, if I would have went into all large caps, it would have been much higher. Small caps, it would have been higher. Some of these other ones, not as high. But our goal is, and again, it's one that sounds easier said than done sometimes, is to try to hedge by looking at the business cycle and saying, I'll emphasize large caps a little more because I think they're a better option at this time. And which, with a declining economy, large cap value was one of the areas you looked at. So when you're looking at this, that's the concept of asset allocation. So, but what I tell people, you don't want to just have asset allocation just always be exactly the same. You want to look at trying to take the business cycle and enhancing that. Again, using market logic, not market timing. I mentioned earlier, this is where we're at in the business cycle. In phase 4, the economy is still slowing down. But what happens is eventually we're going to see them cut inventories, and then eventually we'll start to rebuild them. Things starts picking up, in here. And again, remember, you're starting to buy stocks or looking at more opportunities anyway, as far as things coming back. If you already own them, if you own a Microsoft, I'm seeing the PE ratio on some stocks like that get very reasonable now. Now the question is when do we maybe buy a little bit more of them? Not quite there yet on some of those, but if somebody walks in with $100,000 now, I am starting to pick off a little bit, dollar costing, averaging in to certain holdings. Then it may get to be a little bit better of a buy, but we're still not bad buy in some of these situations now. because we are seeing some very solid companies reflect some very good ratios as we go forward. Just some risks I put in the economy right now. I want to highlight those. The Fed could push the economy into recession if it over tightens too much. And this is why they have a very tough situation. Geopolitically, the tensions in Russia, I mean, that could change the whole energy markets. We have to watch that because that is a big part of inflation, which would be tough if we have to keep raising to slow it down even more. And again, markets may remain depressed longer than a lot of people are predicting. So those are some of the risks. Now, proactive investment ideas, fixed income is actually starting to look a little bit better again. And again, it gives us a little more, less volatility. U.S. equity investors may use profits as a guide to rising rate environments. We are seeing that some of the second quarter numbers are starting to come out as far as companies meeting their earnings expectations. So far, it's been fairly solid. That could change with the next quarter, but it's one right now. It's not as bad as some people thought it was going to be. Again, you invest in stocks where companies eventually make money or are making money, paying dividends, things of that nature. Long-term prospects, a falling dollar and a wide valuation discount support international equities. If we do see, because one of the things, and this has been tough because this has been talked about for the last 2 years, on the international side, a lot of the other countries, and I've got a lot of data on that, that show their PE ratios didn't go as high as ours. So what we're seeing is there actually is some very good buys in some of these other countries. Not yet with everything going on. We haven't seen it come true, but it is one where international might be an area that we look at as we come out of this to take advantage of that situation. Looking ahead, just wanted to highlight, I always want people to understand we do have other alternatives besides just investing in equities and bonds. For example, I was looking at an idea the other day. And again, it's these kind of indexed, buffered types of things that are out there where basically what it did is it allowed an opportunity for a client to say, I can get as high as around, I think it was 8%. I'm guaranteed to always get my principal back. And it guarantees if the market does go down, that I'll at least get an average of 3% over 5 years or 15% at the end of the 5 years. So basically I could put my money in, put $100,000. I'm not ever going to get back less than 100,000. I could get as high as if the market was up, it's based on the S&P. If it was up 8% every year, you could go up that much, or at least I'll get an average of 3% over that period of time. These aren't magic acts. They may sound like, wow, how could they do that? It's all actuarially priced. But those are things for people who say, I don't want to participate in these ups and downs as much. I always want to let people know if you're going to be in the markets, if you're going to take advantage of these returns that we've had, and you look at the 3-year numbers I showed earlier, they are very attractive. You don't get those with things that are going to hedge because you're paying for that hedging process, but they are there. So I always want to let people know those types of things. Let us know any way we can help. Here's our advisors that we have that are here. As far as Oak Tree goes, just to let you know, some of the key areas that we're focusing on right now, we're going through and reviewing a lot of the beneficiaries with our clients, looking at both IRAs and non-IRAs to see if you want to put a transfer and death on your non-IRAs. We're looking at our client experience. We want to make sure that that's ultimate. We are an independent firm. We are not tied to any one company. We are independent. We choose who we want to partner with as far as our clearing, as far as our advisory, fiduciary services. That really is up to us. I like that fact. I worked in major corporate environments for most of my career until I started Oak Tree. Honestly, it gets to a point in this business, I always think there's some conflict a little bit if you're being told what to do as far as what you need, numbers you need to hit on a quarterly basis. We have nothing like that. We are not a stock-owned company. We are not a stock company. So we don't have a board of directors saying this quarter you have to generate this much in revenue. Basically, we do what's best for our clients. The rest falls into place. And we have the ability, being independent, to choose who we want to partner with as far as our various firms that we work with. It's very exciting. And honestly, it's been very liberating for me since 2009 to be under a different environment like that. Again, if you know of anyone else that likes to hear about what's going on in the economy, we're here. We can help them, with some guidance. And again, we do a lot of things. We do not have a minimum. We've chosen not to do that. The only thing that I ask when I'm dealing with clients is they have to be sane. I say that kind of jokingly, but very true. I mean, this is not a magic act. I don't have the magic wand to turn your 10,000 into a million in a week or two. So what happens is we look at logic. That's why it's about 20 some years ago, I'd say probably about 28 years ago, I determined the business cycle was the number one thing to focus on. Because that was, by looking at that, it gives you the best opportunity with asset allocation, I think, to maximize returns and try to protect as much as you can when you have downturns. Again, take advantage of any of our, go to our website. We do have a lot of information on our website. Feel free to look at that if you have any questions. I do want to take a couple questions I've received here. We're in a bear market, I understand it. At what point do we fall into recession? Basically, officially, a recession is 2 negative quarters of GDP growth. Our gross domestic product is actually negative. I think it's pretty much a conclusion that we're either in a recession or will be in a recession. Again, it's somewhat nomenclature. I mean, it's a number. The question is how deep is this going to go? And this is the balancing act of the Fed. You know, they're going to, the 27th, we'll have another Fed meeting. You know, how much will they raise interest rates at that time? It's not an easy thing to do. In retrospect, we shouldn't have put as much money out there. That was probably both a political and Fed situation that we probably shouldn't have done. Now, some of this stuff, you got to be fair to them. It's easy to look at in retrospect. I'm still above water with my portfolio, but the returns are much weaker. Are people's retirement plans actually being affected directly? Hopefully not. I mean, again, I know with our clients, we've built in enough money, and that's why I talk about the bucket, to make sure we can weather storms. That's very important to us. Again, for some of the people that are prospects, that are people that are not clients of ours, go back to that the bucket theory I was talking about. Business cycles will happen. Stocks will come back. If you're in good companies, you'll be okay. But you have to be able to ride those storms out. And if you can't, because you need the money in retirement, that can be a problem. How long before we see portfolios start to do better again? I think we're going to have a bit of a rocky road for a while. And that's why I'm going through the portfolios and trying to look and say, what are we in? Are they good things? We have enough cash to ride things out. And then I'm not necessarily going to panic and get out of those. If we're in something that a company that's not going to survive, then we'll get out of it. But overall, yeah, and that's why when you get into some of the electric car companies, you get into some of these other things. I mean, for example, Teslas and all these other ones that are Rivian and some of the ones you're seeing out there, there'll be survivors and there won't be. It's like with the tech companies out of the early 2000s. There'll be survivors and there won't be. Bottom line is the industry, and the tech industry, we knew was going to be solid coming into the 2000s. Same thing with a lot of stuff we're seeing here. Sometimes you're not quite sure which one of those are going to be, but what happens is we do see that this is a tough one to predict because of some of these I mentioned. Employment's still very good. That is usually we're not sitting with employment levels the way we are at this part of the cycle. What do you feel about some of the newer asset classes like crypto? Again, this is one where I've just been reading a book on this whole subject. I'm trying to honestly understand it more. Again, I've been a person that's invested over the years on companies that have solid products and services and eventually will make money. Crypto is one where it really is a transforming our society to a degree of looking at a different bartering system, for lack of a better term. You know, one thing I like about it, I think when I looked at it, it's when I'm reading this book, it talks a lot about the protections. Because one of the things that always worries me when you're talking about digital things is the hacking and the security part of it, with the way that they mine it and things that they do. It could, at least I feel a little better about that. We don't do a lot with these things. I mean, I have clients ask me about it a lot. It is an asset class. It is a bit of the Wild West now. I mean, you've seen it go from $67,000 down to $20,000. So if you invested at 67, you've got a ways to go to get back. So I tell people with this, make it money that if you saw a big decline, it's not going to change your lifestyle, you know, to a degree. But, you know, who knows? Down the road, you know, there probably will be something like it, depending on who the survivors will be. So that's a question on that. That we have a few other questions that are kind of in that same mode. I know we're up to, I try to keep this to about 45 minutes. I see we're sitting at probably right now about 50. Feel free to give us a call if you have any questions. Again, look at fundamentals, look at the business cycle. We talk about asset allocation. We do have, again, I'm reviewing, if a person is a kind of an individual stock investor, we do look at different stocks. Again, it's a totally different ballgame when you invest in individual companies directly because you're affected by what that company does. So you just need to make sure, besides the cycle and the sector, how they're doing, what is the basis of the fundamentals of that company. And again, looking at right now, last review is kind of investment themes. Look for companies that are going to have earnings. Look at companies that might hold up better during this downturn, things that are more defensive, things that you need. The energy sector is a tough one because those stocks, some of the oil company stocks have been going through the roof and really helped the portfolios. Now we've seen a drawback in that, which you will see if we do see a decline in manufacturing, production, transportation. If all of a sudden people aren't buying as many things, we don't have to get those transported all over the place. So you may see a little less demand on energy if that were to happen. I am worried about what's going on in Ukraine, Europe in the winter, that type of thing. So overall, thank you for your attendance. I know I covered a lot of information in a relatively short period of time. And it's one where, again, set a plan, stick to that plan, make adjustments as you go. I've always equated investing to driving a car. If you're driving a car, and I'll do this kind of here, you don't go like this all the time. Because if you do, you're going to crash, just the way it works. What you are doing is you are adjusting the wheel back and forth to stay on track. And that's really what we found investing is making adjustments, making logical adjustments. And once in a while, a deer is going to run across the road and you're going to have to swerve. Just be careful of how much you swerve because you don't want to tip over. And with that closing anecdote, if you have any questions, feel free to give us a call. And thanks for being on our webinar. Have a great day.